A $25 haircut nets the shop owner about $5. On 200 cuts a week, that is roughly $1,000 of net margin minimum wage for a 60-hour week. So why are barbershops surviving on every street corner in America? Because the smart owners do not run a haircut business. They run two other businesses that the haircut conceals. About 150,000 U.S. barbershops in 2024, $5 billion in reported annual revenue, 8% annual growth. Average shop has 4 to 8 chairs at $25 to $40 per cut. Reported industry net margin lands at 4 to 6% on tax filings. That number cannot be the whole story. If it were, the owners would be working 60 hours a week to make minimum wage with full operator liability. They are not. Two structural features explain the gap. Decompose a $30 haircut at a 6-chair commission shop. Barber commission at 50 to 60%, $15 to $18. Supplies, capes, blades, color, sterilization, electricity, about $1.50. Allocated rent, insurance, business license, roughly $4. Card processing fees, 90 cents. Net owner margin per cut, about $5.60. At 240 cuts per week across 6 chairs, that produces roughly $1,300 of weekly net to the owner. Subtract the owner's own hours, and the math is brutal, minimum wage with all the legal exposure of running a business. So the smart owners restructure the entire compensation model. They stop paying commission. They convert every chair to booth rental. Independent $1,099, barber rents the chair flat, $200 to $400 a week. Barber keeps 100% of cut revenue, pays their own taxes, buys their own supplies, sets their own hours. Now watch what booth rental does to the owner's income statement. 6 chairs times $300 per week equals $1,800 of pure rent income. Only utilities and shared common area maintenance come out. Supplies are now the barber's problem. Margin lands near 85%. That equals roughly $93,600 of nearly passive annual income from booth rent alone. No employees to manage. No W-2 payroll tax. No commission disputes. The owner just became a tiny commercial landlord. The owner can still cut their own clients out of one of the booths as a sideline. Combine the booth rent income with their personal cutting income, and the same person is now earning 2 to 3 times what the same shop generated under commission. Between 2010 and 2024, the percentage of U.S. independent barbershops on booth rental rose from 25 to 62%. The migration is not coincidence. It is the entire industry independently rediscovering the same math. Now the second hidden line that does not show up in industry reports. The IRS Cash Intensive Business Audit Guide, federal training material, explicitly identifies haircare services as one of the top 10 audit flag categories. Statistically estimated chronic underreporting in the 25 to 40% range against true revenue. Cash tip income is the primary vector. 60+% of small shop transactions still settle in cash, Venmo, or Cash App at independent shops. The IRS guide explicitly tells agents not to audit by transaction. There is no inventory paper trail to reconcile. The recommended methodology is lifestyle-audit. Compare reported income to observable assets, the vehicle in the parking lot, the residence on file. If the reported income does not support the lifestyle, the audit gets harder. Smart owners stay calibrated just close enough to plausible reported numbers to avoid lifestyle audit flags. An owner reporting $60,000 of net income may, in practice, be netting $120 to $180. Here is what nobody puts in a business plan. The barbershop is one of the last structurally cash-friendly small businesses left in the U.S. Why does the structure work? No inventory to audit. No employee wage records to subpoena because booth rental made everyone $1,099. 60+% of transactions still off card rails. The federal audit playbook explicitly acknowledges the structural difficulty in the official guide. Smart owners stay just close enough to plausible reported numbers to avoid lifestyle audit flags. The economic moat of a successful independent barbershop is not the haircut. It is the booth rent income and the cash float, both of which compound silently while the front of house pretends to be a hair business. Lesson: when a business has terrible reported unit economics, but the storefronts keep multiplying. Look for revenue lines that do not appear on the income statement. For barbershops, it is booth rent plus cash float. For ethnic markets, it is import distribution sidelines. For laundromats, it is cash and machine float. For car washes, it is land appreciation. Every low-margin small business category has a hidden mechanism that converts apparent poverty into actual income. The ones that survive in low-margin retail are the ones running two businesses on top of each other, and one of them is usually invisible to outsiders.